Part 1. The Foundation. Price versus volume and market mechanics. About 90% of retail traders spend their entire careers staring at a single variable, price. They watch a chart, see a massive green candlestick break out, feel a sudden rush of fear of missing out, and immediately press the buy button. But institutional market participants, hedge funds, proprietary trading desks, and primary market makers treat price as nothing more than a secondary output. They do not trade price in isolation. They trade the underlying fuel that creates price movement, which is volume. If you are entering trades based purely on price action, moving averages, or basic chart patterns without checking volume, you are effectively trading with blinders on. In this breakdown, we are completely skipping the hype, motivational platitudes, and quick-fix trading promises. Instead, we are diving deep into the structural mechanics of volume analysis, the single most effective methodology for tracking institutional order flow. Over the next 14 minutes, we will unpack this framework in 3 distinct parts, starting with the fundamental dynamic between price and volume, moving into the psychological power of the effort versus result model, and finishing with actionable institutional patterns like stopping volume, buying climaxes, and volume divergence. If your goal is to build long-term consistency in the U.S. financial markets, whether you trade the S&P 500 futures, NASDAQ, or high beta equities, this framework will transform how you read liquidity. To master market structure, you must first understand the fundamental divide between what price tells you and what volume reveals. Price represents nothing more than the last matched transaction rate between a single buyer and a single seller at a specific microsecond. It is a surface-level data point. Price tells you where the market has been, but it reveals zero commitment on its own. A candlestick can look overwhelmingly bullish on a 5-minute or daily chart, but if that move occurred on light volume, there is no real institutional capital behind it. Volume, on the other hand, represents the total quantity of shares, contracts, or units transacted over a defined period. Volume measures commitment, participation, and above all, institutional liquidity. When a central bank, mega-cap asset manager, or algorithmic fund builds or liquidates a position, they cannot hide their footprint. It shows up immediately as a spike in volume. Let's contextualize this with a practical case study in the U.S. stock market. Imagine Tesla, TSLA, has been consolidating under a heavy resistance level at $250 for several weeks. Suddenly, a massive daily candle breaks out above $250, closing near its absolute high. To the untrained eye, this looks like a textbook bullish continuation pattern. Retail traders rush in, setting market buy orders right at the market close. However, when you drop down to examine the volume histogram at the bottom of the chart, you notice something critical. Volume is sitting 40% below the 20-day moving average. This is a classic low-volume breakout. What actually happened behind the scenes? Market makers allowed price to drift upward into liquidity pools to trigger retail buy stops, but institutional desks refused to participate or back the move at higher prices. Because there was no true buying pressure supporting the breakout, the market quickly ran out of breath. Within 72 hours, Tesla reversed sharply, falling back to $230 and trapping thousands of buyers. The foundational principle to commit to memory is simple. Price shows you the direction the market traveled, but volume proves whether the market actually possesses the institutional conviction to sustain that level. Part 2. The mental model. Effort versus result and institutional absorption. Moving into the second phase of our analysis, we need to establish the primary mental model that governs institutional tape reading, the law of effort versus result. Formulated by legendary market operator Richard Wyckoff, this principle applies the basic laws of physics directly to order flow and price discovery. In the physical world, if an immense amount of force or effort is exerted on an object, you expect a proportional amount of movement or result. If you stomp on the gas pedal of a high-performance sports car, the vehicle should accelerate rapidly. financial markets function under the exact same cause and effect relationship. In this framework, volume represents the total effort injected into the auction, while the spread or range of the candlestick represents the resulting price movement. Under normal, healthy market conditions, effort and result operate in complete alignment. When you see ultra-high volume paired with a wide-ranging decisive candlestick, effort and result are validated. It tells you that institutional aggressive orders are driving price in that direction, confirming that the current trend is backed by capital and likely to persist. Similarly, when volume is low and the candlestick range is narrow, effort and result are also in balance. It simply signifies a quiet market, normal pullbacks, or temporary consolidation where neither buyers nor sellers are asserting dominant control. The true edge in trading, however, lies in identifying anomalies, situations where effort and result are violently out of balance. The most profitable trading setups occur when you observe an extreme spike in volume, representing massive effort, but the resulting price candle remains exceptionally small, such as a narrow range bar, a spinning top, or a doji. When massive effort produces virtually no price movement, it signals that an invisible wall of counter-institutional orders is absorbing the flow. Consider a live scenario on the S&P 500 E-mini futures or the SPY ETF during an aggressive intraday sell-off. The market has been cascading downward for 5 consecutive red bars, generating widespread retail anxiety. On the 6th bar, a panic-driven wave of selling hits the tape, generating the highest 15-minute volume spike of the entire session. Retail traders see the heavy red volume bar and aggressively short the breakdown, assuming the market is about to collapse further. But when the 15-minute candle closes, the actual price displacement is surprisingly small, leaving a tiny candle body with long wicks on both sides. Ask yourself the critical question. If millions of contracts were sold aggressively, why didn't the market fall another 10 or 20 points? The answer is institutional absorption. Large institutional buyers stepped into the market with passive limit buy orders, absorbing every single sell order dumped by panicked retail participants. The heavy effort of the sellers was completely neutralized by institutional demand. This structural anomaly indicates that supply has been depleted, seller exhaustion has been reached, and a sharp upward reversal or explosive rally is immediately ahead. Part 3. Actionable execution. The 3 core institutional volume patterns. Now that we have established the mechanics of effort versus result, let's break down the 3 distinct volume patterns that allow you to execute trades with institutional precision. The first critical pattern is stopping volume. Stopping volume marks the exact location where a severe, sustained downtrend is forcefully halted by large-scale institutional accumulation. As an asset plunges lower, market sentiment becomes overwhelmingly bearish. To identify true stopping volume, look for 3 specific confluence factors on your chart. First, the asset must be making a fresh lower low within an established downtrend. Second, a high volatility candle appears that features a deep lower wick, indicating price was pushed down but rejected. And third, the volume bar associated with that specific candle must be exceptionally high, standing out significantly above the surrounding volume histogram. This surge in volume, combined with a lower wick, proves that smart money entered the auction at wholesale prices, absorbing the final wave of panic selling. When stopping volume prints, the downtrend is structurally dead, opening high probability opportunities for long positions, mean reversion trades, or major trend reversals. The second institutional pattern is the polar opposite, the buying climax. A buying climax represents the ultimate distribution trap designed to transfer assets from smart money over to uninformed retail traders right at the macro top. Imagine a stock like Nvidia, NVDA, or Apple, AAPL, that has experienced a parabolic run over several months. Financial news outlets begin blasting bullish headlines, price targets are raised by analysts, and social media hype reaches a fever pitch. Retail traders, overwhelmed by intense fear of missing out, begin buying aggressively at all-time highs. However, institutional investors who bought the stock at much lower valuations face a major problem. They hold massive, multi-million share positions that cannot be sold without driving the price down, unless there is an equal explosion of buy orders to absorb their sell flow. The retail FOMO wave provides that exact exit liquidity. You can identify a buying climax through three unmistakable characteristics. First, after an extended, multi-week uptrend, the market prints its widest green expansion candle yet. Second, the volume bar under that candle shoots up to an absolute peak, often representing the highest volume reading on the entire daily chart. And third, despite the initial strong push, the candle begins leaving upper wicks or closes off its absolute highs. This tells you that under the cover of immense retail buying, institutions are dumping their inventory as fast as possible. Shortly after a buying climax occurs, the market exhausts its buyer pool, leading directly to a sharp crash or a prolonged, painful distribution phase. The third essential pattern is volume divergence, which serves as an early warning indicator for internal trend decay. While traditional indicators like RSI or MACD measure momentum, volume divergence measures the underlying health of market participation. Bearish volume divergence occurs when price presses forward to make a new higher high, but the volume supporting that new high is noticeably lower than the volume recorded on the previous peak. This structural mismatch proves that institutional buying is drying up. The price is merely drifting higher because there is a temporary absence of sellers, not because aggressive buyers are driving the market. Once sellers step back in, the price collapses rapidly due to thin underlying liquidity. Conversely, bullish volume divergence occurs when price prints a fresh lower low, but the volume on that new low shrinks substantially compared to the previous swing low. This confirms that selling pressure has completely dried up, leaving the market primed for a powerful bullish reversal as soon as fresh buying interest enters the tape. To trade like a professional in the US markets, you must transition from a passive price observer to an active volume analyst. Before entering any trade, run through your institutional checklist. Is this price breakout confirmed by expanding above average volume? Do I see an effort versus result anomaly pointing to institutional absorption? Is the market printing climactic signatures like stopping volume or a buying climax near key structural zones? When you integrate volume analysis into your daily charting routine, you stop reacting to market noise and start tracking the undeniable footprints of institutional capital.